Welcome back to our channel. Today I would like to share with you some information about how to use family trust as a legal structure and how that can minimize tax and protect your properties from others. The first thing we need to talk about is what is a trust and what are the key players in creating a trust. A family trust is a relationship where a person who is called the trustee is under an obligation to hold property for the benefits of other persons, and those persons are called the beneficiaries. The terms of the obligations are defined by the terms of a legal document called the trustee, entered into between the trustee and the settlor. There are four main players in a family trust structure. The first one is the settlor. The settlor is the person who creates the trust by settling a sum of money or property on trust for the beneficiaries. The second one is the trustee. The trustee is the legal owner of the trust property. The third one is the appointor. The appointor is the person named in the trustee who has the power to remove and appoint a trustee. The last one is the beneficiaries. A unique feature of a family trust is that the beneficiaries do not have fixed entitlements in the properties that the trust owns. The trustee has the discretion to determine which beneficiary will receive what from the trust in each financial year. A family trust remains one of the most powerful and widely used legal structure in Australia for creating family wealth because of the unique features for income splitting and asset protection. I will give a couple of examples now of how a family trust can deliver those benefits. A typical example is where there is a high income earning spouse, a low income earning spouse, and children studying full-time. For example, a husband who is a business owner and earning $500,000 per year, and a wife who is not working. Their son is 18 years old and is studying full-time at a university. Mom and dad are trustees for a family trust. The trust also owns investment properties, which earns $200,000 rental income per year. In that example, it makes sense to minimize tax by distributing the rental income to the mom and the son who are on a lower tax rate. A further opportunity to minimize tax in this example is when money is put into a family trust who is then lent to the dad for investment purposes. In this example, on one hand, the interest expense is tax deductible to the dad who borrows the money at the top marginal rate. On the other hand, the interest income the family trust receives will be distributed to the beneficiaries who are at the lower marginal tax rate and end up paying either no tax or minimal tax. Additional to the income splitting benefit, another key benefit is asset protection. For example, say a business person is having some troubles with his business and owing his creditors about $500,000 of debt. The business person owns no property in his personal name, but is a trustee of a trust which owns 5 investment properties with a total value of $3 million. The question is, can the creditor attack the trust assets? And generally speaking, the answer is no. I hope today's discussion is helpful to you. If you want to know more about how a family trust can help you to create and maintain wealth for your family or business, please leave your comments below, like us on Facebook page, or join us on WeChat.